Can you avoid required minimum distributions, RMDs, by using a trust? Have you ever wondered if you can sidestep required minimum distributions by using a trust? This is a common question in estate planning, especially for retirement accounts. Let's break it down. Required minimum distributions are mandatory withdrawals that individuals must take from certain retirement accounts, like individual retirement accounts, starting at a specific. The Internal Revenue Service has set these rules to ensure that retirement funds are taxed eventually, as many contributions are made before taxes. When you name a trust as the beneficiary of your retirement account, things can get a bit more complicated. However, using a trust does not allow you to completely avoid RMDs. The IRS mandates that distributions must be made to beneficiaries within certain timeframes, whether the beneficiary is an individual or a trust. The type of trust you choose plays a significant role in how RMDs are calculated and distributed. There are two primary types of trusts in this context: conduit trusts and accumulation trusts. A conduit trust requires the trustee to pass all RMDs directly to the trust beneficiaries. This means that the beneficiaries receive the distributions and are responsible for paying the taxes on them. On the other hand, an accumulation trust allows the trustee to keep the distributions within the trust. However, this can lead to higher taxes at the trust level due to compressed tax brackets. The Secure Act has also changed the rules for inherited retirement accounts. It generally eliminates the option to stretch distributions over a beneficiary's life for most non-spouse beneficiaries. This means that if a trust is not a see-through trust, the entire account must be distributed within 10 years of the original owner's death. A see-through trust meets specific IRS requirements, including having identifiable beneficiaries. If your trust qualifies as a see-through trust, RMDs can be stretched over the life expectancy of the oldest beneficiary. This allows for longer tax deferral. New IRS regulations also allow a trust to be divided into separate subtrusts for each beneficiary. This means that each beneficiary can receive distributions based on their own status. Eligible designated beneficiaries can stretch distributions over their life expectancy, while non-eligible designated beneficiaries, like most adult children, must follow the 10-year rule. Naming a trust as a beneficiary can provide control over how and when beneficiaries receive distributions. This can protect assets from creditors or poor financial decisions by beneficiaries. However, this control can come with accelerated distributions and higher taxes if the trust does not qualify as a see-through trust. It is essential for the trustee to understand the trust's terms and IRS rules to avoid unintended tax consequences. Proper drafting of the trust is vital to maximize tax efficiency and comply with RMD rules. In summary, you cannot avoid required minimum distributions by using a trust as the beneficiary of a retirement account. The IRS requires distributions to occur based on life expectancy or within a 10-year period, depending on the type of beneficiary. Trusts can influence the timing and manner of distributions, but they do not exempt retirement accounts from RMD rules.